Hello and welcome everyone to Forge & Foster's 2022 Hamilton Market Update. My name's Alex, I'm the Director of Strategy and Research at Forge & Foster. In addition, for an annual review, we're going to also looking at Q4, and happy to have you guys watching this YouTube video. I know we had our first in-person event for this a few weeks ago. We're recording just at the end of January now. If you were able to make it, fantastic to see who I got to see. I know it was right when the big storm happened, as luck would have it. So keep an eye out for another event. We'd like to see everyone there if possible for the Q1 in April, but we'll talk about that again towards the end of this video. If you haven't already, I really want to say thanks to everyone subscribed to our weekly email. If you really like these sorts of things or are really interested in what happens in Hamilton, we do a weekly email that talks about Hamilton and our surrounding subject markets, about all the commercial real estate activity that happens around here. So here's the QR code right in front of you right now. If you'd like to scan that, you'll be linked to a webpage where you can insert your email and subscribe to weekly emails that get all the information about what happens in Hamilton, the commercial real estate world. But as I mentioned, the topics we're going to be looking at today are what happened in Q4, what happened in the year as a whole for 2022, and with this information that we have, how is this going to impact 2023, and what can we project or think is going to happen for the year ahead. So here's a page that looks at the total commercial real estate dollar volume that we saw in Hamilton. As you can see in the bottom here in 2022, we almost hit $2 billion worth of commercial real estate transactions this year, another record year. We've seen record years for the last 5 years in Hamilton now, and you can see we can see some huge numbers here going back to the last 3, even maybe 2 years in Hamilton. And a big reason of why this is happening, and this is what's going to be informing really the topic of today's video, is interest rates. Interest rates have a huge impact on the market, and I don't think that can be understated, and it's something that's really became prevalent when I was doing this exercise of putting this presentation together. So this next slide shows an average of what the interest rates were, the policy rates were for that given year, and you can see at the beginning we're starting in 2017, interest rates were just below about 2%, and you can see overall from 2017 to 18-19 we're hovering around $1 billion in commercial real estate activity. Then the pandemic hit in 2020, and the government really started to incentivize quantitative easing. The BOC brought down rates to basically just above zero, as much as low as they could, and that really incentivized buying and really kind of gave a shot in the arm of the commercial real estate economy. And you can see how we had a record year in 2020 with $1.2 billion. That skyrocketed up to almost 1.6 in 2021, and it's how we got to almost $2 billion today in 2022. And so this graph here, this is a graph looking at commercial real estate volumes per asset class. In the white is 2021 volumes, and the gold is 2022 volumes. And you can see more or less, you see 2021 stacks up with 2022, but the big outlier here is ICI land, which is industrial, commercial, institutional land. And the big reason here is for the largest deal that occurred last year in Hamilton was for 386 Wilcox Street, also known as Stelco. They sold their land for over $500 million. This is the largest deal I could find through the resources that we use to transpire in Hamilton's history. It was purchased by Slate Asset Management. It's obviously industrial land, 809 acres, goes for just under $650,000 an acre, which I think is a great price for Stelco. It's the third largest GTHA, so Greater Toronto Hamilton area, transaction that occurred in 2022. So that's pretty great company to be included with Toronto and stacking up to be the third largest transaction of that sort of catchment. And then it's projected to be a world-class industrial park, as was slated in the news release, and it's projected to create 23,000 jobs and $3.8 billion for the economy. And this image right here is just was provided in the release by Slate Asset Management, I guess, of what it could look like. And this is a very, very long-term project. I believe, if I'm recalling correctly, that Stelco has about 5 years to consolidate into a smaller area of the land for Slate Asset Management to begin whatever their new project may be. So going back to that original graph, I'm removing that huge outlier, that $500 million outlier in the ICI land, and you have a greater idea of how things transpired when looking at a year-by-year basis with 2021 transactions versus 2022 transactions. You can see industrial lands really neck and neck with what we saw for year over year. We saw an increase of residential land quite a bit compared to 2021, a decrease in industrial, mixed use and retail are about the same, a big decrease in multi-res, and we'll get to that reasoning why a little bit later on, and a slight uptick in office, which is great to see. Looking at it at a quarterly perspective now, so again, just to refresh, we were looking at annual amounts just previously. Now this is looking at Q4, so Q4 2021 versus Q4 2022, and you can see decreases across the board for 2022, which is really perplexing, right? Like we just saw 2022 was a record year. We passed 2021 by about, if I remember correctly, $300 million. So how is Q4 underperforming? And if it's underperforming, how well was the rest of the year doing comparatively? And again, as I tipped off near the beginning of this presentation, inflation rate is the biggest cause of this. And as inflation rate grows, the BOC, the Bank of Canada, is increasing the cost of debt associated in order to squash this ever-increasing inflation rate. So this graph here, you can see in the gold the inflation rate that's been going on since the beginning to the end of 2022, and in white we see the line of the interest rates and how they've kind of gone step in step. So you can see at the beginning of January, inflation rate was around 5%, goes all the way up steadily in June to hit a peak of around 8%. And if you look at the policy rate, the interest rates, very, very low. Again, really much influencing that buyer mentality of what we've seen these record years for the last 2.5, 3 years. And then in May is when it really starts to kind of pick up. So May we see the policy rate be 1%. It goes up 50 basis points at 1.5 in June, goes up a full 100 basis points to July, stays steady for a month, and then goes up another 75 basis points in September to 3.25%. So from May to September, we've gone about 2.25 percentage points in interest rates, which is huge, not just because we're hitting a huge number, but at the pace that they're going to as well. And you can see it's having an effect, as you kind of see for the latter half of the year of 2022. Inflation rate starts to dip a little bit, even though it gets a bit sticky towards the end of the year. But BOC continues to increase policy rates, but not at the same rapidity as we saw in the middle of the year. And it's important to remember throughout the rest of this presentation that really the end of summer is when things start really to pick up steam in terms of increasing interest rates, and to what effect that had on for their 2022. And we had a glimpse of that a little bit just with the previous graph. With Q4, we saw really reduced transaction levels, and that's really the first indicator of the impact of interest rates. So this next graph looks at the number of commercial real estate transactions we see in Hamilton per month. And what I really want to focus on here is the red line, which is the number of transactions for 2022. And everything else you don't need to decipher, but really use that as a gauge to see how seasonality really impacts the level of transactions throughout the year in Hamilton. So if we were to look at the beginning of a year, we see January, February, March, quarter one, really kind of is average. We started kind of seeing a pickup from like the lull of winter in December. As it goes into the summer, activity peaks up. Towards the end of summer, we see a natural decline. In September, like August, September, are actually on average the lowest times of the year we see transactions. And then as we get through the fall, it starts getting back up to an average rate, and then that whole cycle repeats again. So now if we look at 22 to compare to that, we had a really wonky Q1. We had a record January, followed by a very low, or a low February, and then again picked up in March. And we see really exceeding averages, and that's exactly what this quantitative easing, the 0.25% policy rate at the beginning of the year was incentivizing. And then we get to the summer, same sort of transaction transpires. And then remember that time between May and August where the policy rates hit, that's when it's occurring, but you're still on top. And then it takes a little while for commercial real estate, or this effect to really have on commercial real estate, because commercial real estate transactions occur between like 60, 90 days, even longer for transactions to occur. So with that mindset as well, to really be informed that these transactions get delayed. It's not imminent when these policy rates get enacted that all of a sudden like buying gets changed in some factor. No, they have like a little bit of delay of a quarter or two for these really to kind of really show up in the market. And you can see that in the data here with transactions hitting lows in Q4, and we saw that in the dollar volume in the previous graph as well. So this is the last graph of this first chunk, and you can see these are the dollar volumes per quarter going all the way back to 2017. So the gold graph or bar on the right side is Q4 2022, and you can see the slightly less colored bars are Q4s in other years. And you can see, if you kind of look across the line of $250 million there, it was the weakest Q4 that we've had on record, which is very surprising, again, with the context that we had a record year in 2022, and we had actually the weakest Q4 ever since going back to 2017. Absolutely wild to think about that. And if you can look at this graph a little bit further, if you want to conceptualize it in annual increments, starting at 2017, Q4 was actually a little lower than Q3 and Q2, but if you look at 2018, 19, all the other years, Q4 is actually the strongest quarter of those years. So that really is compounded when you think about how Q4 is the weakest quarter for this year when it traditionally is the strongest quarter of any given year. Looking at the numbers, we saw $261 million of commercial real estate transpire in Q4, comparative to Q3 of $434 and Q4 of 2021 of $574 million. It's really low. It's about average actually, but looking at it from a perspective or relative to record years, it looks really low. And same with the number of transactions. We saw 101 transactions transpire in Q4 2021, so about a year ago, comparative to Q4 2022 of 79. It looks very, very low, but over 100 is absolutely massive, and the high 70s is actually the average here. So we actually kind of saw an average year, a little bit of a low year still, for Q4 of 2022, comparative to very voracious years of 2021. And this is not just affecting the commercial real estate market per se. We're also seeing it, I think, affect building permits too. As you can see this headline here, Hamilton hits earliest ever $1 billion building permit mark. As of June 17, Hamilton passed $1 billion, making 2022 the earliest the city has reached a milestone of value. Coincidentally enough, 2021 was also another record year for hitting the $1 billion mark, the earliest ever, so it's fantastic to see 2022 hit it faster than 2021, which was a record year. However, 2021 hit over $2 billion worth of commercial real estate value, or building permit value, I should say. But that mark that was not achieved this past year in 2022, as we saw building permit values hit $1.8 million in Hamilton. So I think it really kind of is in lockstep with the data we're seeing for commercial real estate as well. So this next segment, I'm going to cherry pick a few asset classes I want to talk about. And remember, at the beginning of the presentation, I mentioned multi-res values are really way down, and this is going to be helped by these two graphs here, why that's happening. And the first one is the amount of multi-res transactions. As you can see, we see about 4 to 5 transactions per month of apartment buildings trade in Hamilton. And as you can remember, again, that summertime was when that huge increase in interest rates occurred, and how the effect happened in Q4. And you can see we actually hit 0 in October, 1 in November, and 0 transactions in December. And it's a huge value, or a huge effect. And mainly because I believe multifamily or multi-residential asset classes is very particular, is very affected by this interest rate increases. It has predominantly the lowest cap rates that we see of any other asset class, and it's such a strong asset too, with the rise of rental rates that are increasing right now, just the overall need of housing. It's a very good asset to be invested in, and sometimes investors even can afford to operate in a negative yield for a year or two when they purchase these. So now that interest rates are increasing, cap rates are increasing, it just doesn't make it feasible to acquire these assets at the values that we had when we were at 0.25% for a policy rate. Now those are increasing, so we kind of have to figure out how these values are going to change and what's going to occur for the future ahead. And you can see values are still very much up. We actually saw a huge increase in value. If we look at the next graph here, in 2021, the average value for a suite in Hamilton was just under $200,000 a suite, and that went to about $240,000 a suite for this past year, and a lot of it was due to rental rate increases. Retail, it was a great year for retail. It wasn't like standing out comparative to industrial or anything like that, but I really want to point out retail because I feel like retail as an asset class is very almost like radioactive, like no one wanted to touch it. Retail was dead, especially during the pandemic. Everyone was buying online. But I really point out these two transactions here that went for under $15 million each, just to really highlight that it's starting to become part of the vernacular, part of part of the fabric of the commercial real estate world, and it's great to see that it's becoming a wanted asset class, and in some instances it can really survive on its own as an investment too. Not to say that retail is super out of the woods, but we see large landowners really start to pivot to residential, because again, that's a very strong asset class to still be associated with. And we saw some huge news last year for some of the bigger malls in Hamilton and how they're going to be transforming and repositioning their assets. So Eastgate Mall was the biggest purchase in 2021. And now they're preparing multiple towers, the tallest being 40 stories. In total, they're actually going to reduce their footprint of the mall, and the residential development that they're planning for is going to be over 5,000 units. Timeline remains unknown right now, won't likely begin until a couple years. Also on the mountain, Cadillac Fairview's Lime Ridge Mall is also repositioning or redeveloping their food court, in addition to building 2 towers of 12 stories. There was also in the news recently that Tesla wants to build their biggest retail and service center in Canada at the mall in Hamilton as well. And then really close to Eastgate again, 200 Centennial Parkway North. This is a smart living or smart centers asset. They're looking to do 4 mixed-use towers of almost 1,200 units. It's the first phase as well, and the entire plaza is 13 acres, so there's much more that could potentially be added to this site. And I should mention this is in the Centennial area, which is the border of Stony Creek and Hamilton. There's its own secondary plan for this area, and it was announced earlier in 2022 by the Ford government that they're going to be kickstarting off a new GO station at Confederation, which is just at the north of Centennial as well, which I think it really helps influence a lot of these developments being positioned right by transit. Staying on the topic of development, these next 3 slides are going to be looking at some of the 3 larger developments that were announced last year that I think are going to make an impact in Hamilton. This first being 60 to 190 Main Street West. This is by Bentel Green Oak, so a big player. They're doing 3 27-story towers around Hess Village, and this is a really up-and-coming area. We're seeing a lot of development occur around the Hess Village area. It's going to be huge for Main Street. It's a big parking lot that's just going to be ripe for development. Next is 1284 Main Street East. This is the former Delta Secondary School, purchased by New Horizon Development Group. They just released plans to do about a 14-story development nearing 1,000 units. It's also near the LRT route. It's going to be surrounded by stacked townhomes as well. And they also purchased a site on the mountain that was a former Walmart. So again, staying in that theme of retail sort of repositioning. And it's going to be 8 buildings, 8 to 25 stories, nearing about 2,000 units too. So it's great to see, in particular by New Horizon Development Groups, really taking these assets that are a little bit underutilized, especially the school that was not being utilized at all, and repositioning it for residential, something that we direly need in Hamilton and for the rest of the province. And this next map looks at a map of downtown. The red dot is 115 King. This is where we held the presentation live at the time, but it really just provides some context of what these white areas are. And these are areas that were purchased or starting to be developed now for residential development, high density in the last 3 years, and it really paints a little bit of a picture of downtown and the type of activity that we're starting to see, and the buy-in from a variety of investors to really instill a new form of life in the form of residential development. And the last asset class I want to talk about is residential land, as I'm starting to see some new trends, very new trends in this asset class. And I'll start with 98 James Street South. This is the Connolly building. If you're from Hamilton, you very much know this site, as it's been in the works since 2014 to be a condo. It was recently purchased, when I say recent, maybe around last summer, for $24 million, which equals $113 per buildable square foot. Also equals $75 million an acre, which is huge. To provide some context, for 30-story developments in Hamilton residential, the average per acre price is about $9 to $12 million an acre. We also look at per buildable square foot as a more accurate metric to value residential land, because it takes your purchase price, or what you associate the value of that land, divided by what you think you can build, so the square footage of your potential development. And that really helps inform the value of that land comparative to whatever your underwriting is for that development. So $113 per buildable square foot. The average that I've been seeing for residential land that's similar to this, that can build it with 30 stories, is maybe 20 to 30, sometimes lower. Very recently, we've seen 2 transactions of $40 per buildable. So to see something 113 is absolutely mind-boggling. And at the time I thought this was an outlier, but then in October, November, I saw 15 Cannon Street West. As you can see, this is on Cannon Street. It's already built a little bit, but development went into receivership, was purchased for $8 million, which is over $200 per buildable square foot. And then 282 McNabb sold in December for $6.5 million for $86 a buildable square foot. So I think this is a trend that's starting to happen, and this is something that is not uncommon in larger markets like Toronto. There's a great group out there called Bullpen Marketing that looks at land transactions, but they have a frame that looks at pre-application for development versus post-application, and usually 9 times out of 10 the post-application land is worth more because there's some sort of work that's already been done, an approval process that's been had on that land. And I believe that's what we're starting to see in Hamilton, because all of these transactions that have in common is that there's some sort of approval that's been enacted on the site already, whether it's a plan, zoning, official plan, whatever it may be. There's something that has moved the project forward, and I think that's why we're seeing an increase in value. Also, 2 of these 3 developments are located near transit, GO stations as well, so I think that might be a factor as well. But I think whatever it may be, I think it's a sign that we're starting to mature as a market in Hamilton, and it's really amazing to see that we're moving along and starting to get into the leagues of larger cities that are seeing larger developments like Toronto. Looking ahead, so with all that in mind, what's the view ahead for 2023? So we're going to look at some information before we start to get into some conclusions. So Toronto still tops North America in crane index. RLB does a fantastic crane index twice a year to really look at 12 cities in North America and how many cranes they have, and they use that as a moniker or an indication to see the development that's occurring in these cities. So the GTA dropped 8.7% compared to February, but its total of 230 cranes was still 5 times as many as Los Angeles, and Los Angeles ranks 2nd in North America. So activity in the GTA is still voracious for residential development. And if we want to pair that with this statistic that Canada is aiming to welcome record numbers of immigration for the next 3 years, they're looking to welcome 465,000 new permanent residents in 2023, 485,000 in 2024, and 500,000 in 2025. And as this Globe title says, Canada's cities see immigration-driven population surge after a pandemic lull. The Toronto region in particular is actually losing significantly more people to other parts of Canada. Over the past year, its population growth was entirely driven by international migration. And Mike Moffat, who leads Smart Propensity, which is a think group based out of the University of Ottawa, is quoted as saying, "This is not like 50 years ago when people were leaving downtown Toronto and moving to Etobicoke, they're moving to London or Moncton." And I think this rings true for Hamilton as well. And as we see in this graph, net intraprovincial migration for Toronto area, and intraprovincial means people who live in the province that are moving to other parts within the province, and you can see huge decreases in Toronto for the last 5 years or so. And this isn't a trend that's been happening since the pandemic, it's happened way before, but it's really been exacerbated by the pandemic as well. And so where are they moving to? Well, this graph is a little bit old. It's just a year old because it looks at the census data from 2016 to 2021. But you can see in the bottom right here, those green bars, this represents Hamilton, and the green specifically represents intraprovincial. And we saw a huge increase in intraprovincial population coming to Hamilton, and you have to think this is because of the huge increase of immigrants going to Toronto and then looking for places elsewhere to settle. And you can see in this graph, just very quickly here, that Hamilton, the GTA, just below the GTA total there, had a record number looking back at 2017 of population growth that occurred in 2022 when it accepted 10,000 people. If we look at this comparative to housing, how much housing do we have? Do we need more housing? Well, CMHC believes that we need 1.85 million more homes in Ontario to target a level of affordability of 37%. Smart Propensity, which is the same group I just referenced, thinks we need a total of just over 1.5 million, which is very much in line with the province's mandate of getting 1.5 million homes in 10 years. They specifically believe Hamilton needs 52,400 more homes. And if you want to chunk that up into a bit more specific categories, we need about 38,000 more homes for the existing housing shortage, and we need about 14,500 for the projected number of families between 2021 and 2031. And if you look at CMHC data to see how many completions are being done in Hamilton, we're barely scraping 3,000 homes a year. So if we need about 5,200, divided it by that 10-year segment that we just looked at, we're not nearly building enough homes for that 1.5 million home mark that Smart Propensity put forward. So we're already currently operating in a shortage of homes, and we're not building enough in order to build enough for affordability that's been outlined by Smart Propensity or even CMHC with their larger target of 1.85 million homes. On that report that Smart Propensity put forward, it says surrounding communities should expect high and increasing spillover demand over the next decade as families in those communities drive until they qualify to find attainable housing. And again, this is referencing Toronto and a couple other regions like York Region and Peel Region, and how they're looking for places elsewhere like Hamilton, like London, etc. to settle. And this is the last graph I'm going to talk about, but this is from CBRE. This is a figure looking at lender appetite for Canadian markets. So they surveyed a bunch of lenders that lend to commercial real estate to get their opinion specifically for this figure about Canadian markets, and there's a variety of Canadian markets here. So you can see the legend at the bottom here, but I'll just go through it quickly. So the leftmost green color, this strong appetite to lend in that market. The darker color beside it is moderate appetite. The bright green in the middle is deal specific, the yellow is relationship specific, and in gray is no interest at all. And I rearranged this graph in the next slide, you'll see, to just really provide the totals for strong interest to moderate interest, because I believe deal specific is really exactly that. It's deal specific. It's not a great indicator of what their influence is on that market. And relationship specific isn't really about the market, it's really about that relationship, as that graph said. So if you were to rearrange it, and maybe I'm cherry picking a little bit about this, or maybe I'm a bit biased because I'm from Hamilton and believe in it, but Hamilton is right below Toronto, Vancouver, Ottawa, Montreal is the fifth largest city in terms of appetite from commercial real estate lender perspective, which is really amazing to see. And it's also, for me, great to see Waterloo regions in there as well, because that's a subject market of ours that we invest in. And I really think that Hamilton and Waterloo are really birds of the same feather in terms of scale and the type of rise that they're seeing both in their city as they progress forward too. So it's fantastic to see a huge appetite from commercial real estate lenders for Hamilton. So that was a lot of information. Thanks for sticking with me. Just the last couple slides here is literally a recap, just to summarize everything that we just got through and just digest what occurred. So interest rates have had a pivotal impact on commercial real estate market. We're seeing extremely low interest rates provided an increase in demand to buy for the last couple of years, which has really provided record years. Increasing rates, interest rates in conjunction with the rapidity have reduced demand. As a result, we'll see increased prevalence of vendor take-back mortgages. So something that we're seeing right now is that with the cost of debt being so expensive, you're seeing a lot of seller financing being more prevalent in transactions now. Cap rates are rising, which is in turn reducing values, which may push asset owners to hold or sell. So those who believe they don't want to sell for values that are lower, that they purchased at maybe a couple years ago, if they're able to wait for a full year until interest rates start to decrease a little bit, as inflation starts to decrease a little bit, maybe they'll do that option. Others that aren't able to wait might have to sell right now, and then therefore would lead to discount purchases. As inflation continues to cool with the stable policy rate, may begin to see the Bank of Canada start backing off tightening. And so this is projected optimistically end of 2023 or beginning of 2024. For 2023, I believe Hamilton is going to see a little over $1 billion in transactions. We're not going to see 1.6, close to $2 billion anymore. That was really influenced again to very, very low interest rates. The first commercial real estate asset that's being influenced right now, as we talked about, is multi-residential. Hamilton has a great foundation, I believe, to begin its recovery in the end of 2023/beginning of 2024. Currently have a housing shortage. A record number of immigrants are coming in the next 3 years. Industrial is also still very strong. It has currently a 0.7% availability rate in Hamilton. Retail is going to continue to move forward. It's going to pivot to other uses and to diversify its portfolio, as again, we're going to residential. I believe office, we didn't talk about this a little bit, but I think office is going to have to do a similar pivot as well. And then land transactions, that's also seeing tough financing as well. And I think only very capable builders and buyers are going to be able to move forward, I believe, this year for land. But again, the foundation is very strong to build industrial, to build res, and I think that'll resurface again towards the end of the year. And tons of land, if you can remember all the way back to the first slides, have been purchased in the last couple of years. So there's lots of ripe land that are being primed for development that will occur hopefully by the end of the year again. So that's it for me. Again, if you want to really subscribe to a weekly dose of all this information, please go back to the beginning of the presentation and you can scan that QR code to subscribe to our weekly email. If you have any questions, as always, feel free to reach out to me. My email is located on this page right here. It'll also be in the description of this YouTube video if you ever want to contact me. And again, keep an eye out. We're thinking about doing a Q1 in-person presentation. That'll be much shorter as we're not looking at a whole year and projected ahead in Q4. We're just looking about Q1, so it'll be a bit more concise, I promise. And thank you as always for viewing these presentations, and I hope to see you in the future. Thanks.